Hi, guys. Welcome to the How I Raise a Podcast, the show where you get an inside look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Andrew Ackerman. Andrew is a professor, an investor, and author of a new book called The Entrepreneur's Odyssey. We cover a lot of things in this episode, including tips for your pitch deck, the art of the ask, prospecting for investors, portfolio company jitsu, term sheet negotiation, and more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or FundingStack.com if you're a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a new Get Intro tool to get warm intros to those investors, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Andrew.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Andrew Ackerman coming to us from New York. Andrew runs Reach Labs at Second Century Ventures. He's also a professor and author of a new book, Entrepreneur's Odyssey. How are you doing?
Great. Thanks for having me.
So you wrote a book. Why'd you write a book?
That's a very nice way of saying, do we really need another business book?
Right.
And it's a question I asked myself before I started. I'm one of those guys, I'm like the worst offender. I have zero patience for business books. Like a lot of them are, no offense to your books, but they tend to be ghost written in that same kind of business, boring, bland. So I wanted to say something about how to create a startup from soup to nuts, but I didn't want it to be the same kind of book that would make my eyes glaze over. So I actually remembered a book, the only book I remember from business school, a book called The Goal. Do you remember The Goal?
I remember the title. I don't know if I read it. I'm not sure.
The idea behind it was written like a novel about a guy that had to turn around a printing plant and was in way over his head, didn't know what to do. So he runs into a consultant on an airplane who kind of becomes his mentor and teaches him or kind of gives him the tips along the way. And what's cool about the book is that it was used as a textbook for strategy and operations business school. And it was just a much more memorable way of getting that material across. If you ask somebody who's been to business school at the right time, what the Herbie is, he immediately remembers the scene where like Herbie is the kid that's slowing down the entire Boy Scout troop. And, it's a way to illustrate the author's theory of constraints. So that I'm like, if I'm ever going to write down everything that I've gotten through 20 years of investing and mentoring literally like close to 1,000 startups, I'm going to do it like The Goal. I'm going to write The Goal for startups. And then it was just a question of finding time, which is why I sat on the idea for like 5 years.
Yeah, interesting. So it covers, give us, broad strokes. It's covering the Entrepreneur's Odyssey. It's coming from really kind of starting up,
Here,
doing an MVP.
I'll set the scene for you, and Nathan, you're gonna laugh a little because you know exactly what this is like. So it starts off in a law firm, evening event, kind of mediocre crew to day and back. You've got the second tier associates from the VC funds up front on a panel, and you've got solo founders pitching their ideas. Like we've all been to that. That's the starting point for a lot of it. And then from there, it takes the founder all the way through. He meets an angel investor that becomes his mentor. Then he kind of makes him pivot from his original idea, which happens a lot, helps him go through the process of customer discovery, all the way through every step you need until the last third of the book is about actually raising the round, his first round of financing. So that's the kind of plot arc.
Yeah, very good. And maybe before we get into it, just share a little bit about your background for folks who aren't familiar with you. What have you been doing that led up to this point?
My career only makes sense in retrospect. I mean, I started my career in consulting, which seemed like a good idea in the late 90s, where like entrepreneurship wasn't a thing. If you were an entrepreneur, that was like, oh, so you're unemployed. They didn't teach it in business school. So I went, when I graduated Chicago Booth, it was like, right door is iBanking, left door is consulting. And I knew I didn't want to do iBanking. So I did consulting for 4 years, great finishing school. Not what I wanted to do ultimately, but then the internet started happening. So I hightailed it back to New York, Within a couple of months, I'm in my first startup, a startup called Bunk One. So we would call that SaaS for summer camps these days. I personally exited 8 years later, worked at a family office, and I didn't know it at the time, but I was actually doing a mini venture studio within the family office. So I did that for 3 years, among other things. Then I did my second startup. That was interesting. That was a digital memory platform for parents. There was some founder drama there.
Mm.
And then before doing my third startup, I got pulled into a company called Dream Adventures, which was the third oldest accelerator slash VC fund. And I went from everything from doing your archetypical pre-seed, pre-revenue startups, all the way through to later stage, post-revenue, pre-series A startups. And then I did everything else.
Yeah, interesting. Yeah, you've covered a lot of bases. Accelerator, venture, startup, family office. I don't know what you have left. Corporate VC, I don't know. Everything.
No, but I write and I consult a lot about corporate VC and venture studio. So if there's a six-sided table somewhere, I've sat at maybe five of those sides.
Interesting. Does that exist? That'd be cool. Um, cool. Well, let's get into a couple of the concepts. And I want to, I know there's a lot in this book, but I want to touch on some of the fundraising related topics. I guess it makes sense to start with pitch deck, which is part two of your book.
Mhm.
Um, here's maybe start with this. When should a startup start thinking about raising capital? When do you start building that pitch deck? And your thoughts on building a pitch deck?
So this is going to be a little contrarian, right? You should be thinking about it from the very beginning, but you shouldn't be obsessing about it. You shouldn't actually do it. Now, here's the reason I say that. And it's also the way I built the course I got kind of roped into teaching. If you want to be able to raise money for your startup, and bear in mind, VC money is not the only be all end all about how you can fund a startup. It's actually probably the least worst alternative for a subset of new businesses. Like there are a lot of companies you can bootstrap, you can raise out of revenue. There's a lot of other ways to do it. The reason we talk about, VCs and our startups is because the startups, when they have new ideas that are like fresh to the world, no one else will give them money. Like banks won't lend to them because it's not like a gas station, right? So it's the least worst alternative for the kind of startups that we work with. But with that caveat, being able to raise that money implies that you've built the business that's fundable, right? I always tell people, build your business and it'll get funded if you build it right. Don't like build a business specifically to get funded. But if you know you need to get funded, you can work backwards from there what you need to do. So if you have in mind, this is the pitch deck I need to raise money from a VC, then as you go like, well, what do I need for each of these slides? Well, then that's what you got to do to build the startup. So you're kind of working from the end goal backwards to figure out what you need to do. And that's actually how I constructed my course. When I teach it as if my students are building startups they're going to pitch, and they do actually pitch them to guest VCs at the end of the course. And along the way, you learn everything that needs to get done to really build a startup.
Yeah. Okay. Other tips. So I think that's interesting, kind of working backwards from the end in mind. Other thoughts on building the pitch deck? What makes a good pitch deck? You've seen a lot of them at Dream It and in other parts of your career. What gets your attention, right? It's interesting because I feel pitch decks, it's a little bit like, I know good when I see it. It's a little bit hard to describe sometimes what a killer pitch deck is. But when I see one from one of our customers or founders, that I'm like, this is really good. Like you told a good story, you captured my attention. What do you see?
Yeah, so there's an hour and a half kind of masterclass I give about the pitch deck where I work through it slide by slide. I'm going to guess you want a slightly shorter answer than that. So
yeah, that'd be good.
So let's start with this. Here's the mental position you have to be in, right? Your pitch deck is like a chain. Your startup's like a chain. Each link in that chain represents something that's critical to your startup. And unlike say a rope, where if one thread is not is broken, but the rope as a whole will stand. In a pitch deck, if any one link is weak, the chain fails.
Mm-hmm.
Right, so you have to think back, like, what's the entire chain? What are all the elements that I need to prove to a VC and to myself to make this worth doing for the next 8 years of my life? So like, okay, well, we got to do a total addressable market slide. Well, okay, we can make sure that's a strong link in the chain. Even before that, we have to make sure that we have a problem that's actually widespread and painful and frequent. Right? Okay, we have to make sure that chain is right. That link in the chain is right. So you can't look at it and be like, yeah, a lot of them are strong. These ones are a little weaker, but it'll be enough. It'll hold its weight. Each link is a reason. Each slide is a reason for a VC to say this isn't going to hold. So you need to make sure you've got them all down. And in a weird sort of way, because of that, all successful. I'm going to crib one of my books I hate the worst. There's a book called Anna Karenina, horrible book. It's like a soap opera, best first line ever. And to paraphrase that in the startup setting, it's every successful startup is the same. Every unsuccessful startup was unsuccessful in its own spectacular way.
Mm. Sure. Yeah. It's good. I like that. Good stuff. More thoughts on pitch deck? Anything else? Like what common mistakes folks make, what not to do?
Sure, I'll give a couple of my pet peeves.
Yep.
One is if you can ever find me the guy that thought it was a good idea to create a Tam Sam Sam slide, please let me know so I can go beat the crap out of him. Like that
Why
is
do you
the
feel that way?
worst slide in every deck. So first of all, if you get 5 people in a room and ask them what the difference is between service addressable market and service obtainable market, 3 people will give you a blank stare and the other 2 will fight about it. Right? Nobody knows what those words mean. What's more, like I just want to know what the total market is. Like that's it. I want one number. If you give me 3 numbers, I know at least 2 of them are wrong. Probably the third one's wrong too, because you did it like top down instead of bottoms up. So number one, don't do that. Your total addressable market is really third grade math. How many people are there out there? How many companies are out there that could buy your service? How much are you charging for it on average if you have different price tiers? So A times B equals C.
Yep.
That's it. Don't overthink it. That's pet peeve number one, also most common mistake number one. The other one, just to give you 2 examples, I get this a lot. Where does the team slide go in the deck? Does it go up front or does it go most, towards the back? The thing to remember about the team slide is that the team slide isn't really who the team is. That's trivial. The team slide is why this team is the one that's going to make this startup a big success. Like why them out of all the other people out there? I want to put my money on that jockey. So if the team is answering why, then it needs to go in the back because I don't know if you're the right team for this idea until I know what your idea is. So I need to go through that part of the deck. Then I'm like, great. So this kind of startup needs this kind of team. Yeah, that's you. Now, the exception is if you're like the 5th person on it, like Facebook or Google, and you've had 4 prior startups, then like you put that on slide number 2 and the guy's writing you a check. It doesn't matter what the rest of the deck is. So if the team is the story, it can go up front. But in the other 98% of the time, when you're merely a great team with the right skills for this idea, it's got to go towards the end.
Yeah, it's interesting. You have a chapter in the book under the pitch deck called Hold the Sizzle. What's that about?
So the sizzle slide is also one of the often misused slides in the deck. So just to put it in context, right? You got your cover slide, which believe it or not, people can screw up, but not so badly. And then usually one of the next 2 slides or next few slides are problem and solution. Sometimes it makes sense to actually go from your cover to a sizzle slide. So the sizzle slide kind of grabs the investors by the sleeveless Patagonia vest and pulls them forward and says, these are the things I want you to look at. This is why we're awesome. Pay attention to these things, right? So it might be like, listen, I've got 3 prior startups and I've generated $300 million in exits from my other investors. Okay, great. That gets the investor's attention. It could be, an overview of your traction. Hey, I'm already at $1.5 million ARR in a space where everyone else is getting started. Or it might be like, I got one of 5 people in the world who have the technical skills to do this, and the other 4 are in academia. It's not an overview. And that's what happens. That's the fail for the sizzle slide. They treat it like an overview slide, and you're trying to cover everything. And then you get sucked into ask, because we have ADD, right? As investors, we start asking questions. And now you as the founder are stuck doing your entire pitch deck on that one slide. So it's really like, pay attention to these things. And it's okay not to have it, right? Worst case scenario, or even in some case, best case scenario, just jump into the problem, go straight ahead. But if you're going to use it, it's like a big, bold yellow highlighter.
Yeah, I like it because I feel like you said, investors all have ADD. You got to capture their attention quickly or they tune out. Start playing with the phone.
It's the inverse, right? Let's say you've got a startup that's kind of like a bunch of other startups they've looked at.
Yeah.
And they're already like, oh my God, not another fractional real estate ownership on blockchain, right? Like I'm throwing up in my mouth already. But yours is only superficially like that. And you're really doing something interesting. But like you could lose them already because you go into the problem. Like I've seen this slide before, just with different graphics. So you could put up that like I want to knock you out of the misconceptions you're in. And like, it's not another fractional blockchain real estate startup because, and then you're like, okay, now I get it. Okay. So sometimes you can do that if you need to kind of punch through a misconception.
Yeah, that's interesting. I like it. All right, let's see. What else do I want to ask? You have a chapter called Getting Milestoned, which is fun title. How do you like to see milestones? Are we talking about historical milestones or forward-looking milestones? And what
And
are
so
your eyes on that?
to the extent anything in our industry is kind of standard, things like problem solution, revenue model, total addressable market, those are all standard slides. Milestones are a little not non-standard. You don't see them in a lot of decks, but they're the kind of things that you and I look for that tend to get spread across a bunch of different slides. So I tell my startups just have its own slide to cover this because it's kind of powerful altogether. So if you visualize it, it's a timeline. Somewhere in the middle, there's like, this is right now. On this slide, it's from the beginning of your startup till now. And the story here is, look how far I've come in such a short period of time with so little resources. And then the remaining part is usually plus or minus 18 months. It aligns with like how much money you're raising. And this is where I'm going. Right. And then the beauty of it is as you're done with the milestone slide and you're saying I'm 18 months out, I'm going to be in like 5 countries with $3 million ARR. And then your transition is, and to get there, I'm raising $3 million. And then you're in your ask slide. So it works well. And you can put like the internal milestones, like things you built, and the external milestones, things you've achieved, number of customers, revenue, patents, maybe, different investment rounds. You can put those on the bottom of the line. And it's a very powerful way to get like this train is leaving. You want to get on it,
Yeah,
to an investor.
I like that. I like that. Yeah, you don't see that timeline or milestone slide that often, but I think it's very powerful. Like you
It's
just
done
said,
right.
know
Super
what you've
powerful.
done on nothing with no resources, and to show
Mhm.
where you could take this with some financial backing. I like it.
Mhm.
But one more in this, I think. You have a chapter called The Art of the Ask. How do you like to see the ask? Like, what do you recommend
Oh,
in terms of?
number one, I like to see the ask. There was a period of time a couple of years ago, it was briefly in vogue not to have your ask slide. And I'm like, why make, no pun intended, why make me ask for your ask, right? Just put it there,
Uh-huh.
right? It's not like I'm going to say, like, I was going to give you money, but since you were like rude enough to tell me how much you wanted, I'm out. Like, there's no logic to not having it.
Yeah.
Like, unlike the guy with Tam Tam Slum, where I want to really like kneecap him with a pipe, like this guy, I just want to smack on the back of the head. I'm like, what were you thinking? Um, so first of all, I want to see it. Second of all, I want three things up front and one thing kind of somewhere else on the slide. Usually I get one thing up front, I get the thing at the bottom, and the other two they forget to put in. So number one, how much money are you raising? Thankfully, we almost always get that. But the two that I miss is where are you going with it? Meaning what milestones are you hitting with it and when do you hit it? And then and only then do I want a use of funds. So I'll break it down to you. Like no one wants to put half a tank of gas in a rocket ship, right? It doesn't help getting you halfway to Mars. You're all dead. So if you tell me like I'm going to raise I want to raise whatever I'm raising to get to $500,000 ARR, I'll ask you, hey Nathan, are you able to raise your next round on that? Or are you cash flow positive and don't need another round? You're like, no. I'm like, well, that's half a tank of gas, right? Now,
Mm.
if you tell me I want to get to $2 million, I'm like, yeah, you can get an A round together based on 2 million ARR. You've chosen probably the right milestone. And then I want to know how long it's going to take you there. If you're like, I'm raising for like 5 years, I'm like, no. If you're like, I'm raising for 6 months, I'm like, hey, I don't believe that. And B, you're going to be fundraising again in 3 months. So it's usually 18 months plus or minus. But I want to make sure I got that. I want to make sure you've raised enough money to get to the right milestone in the period of time you've said. And once I know that big picture, then I can look at your use of funds and I'll be like, you're not going to get there with only one more sales hire. Or, you're hire like 50 tech people. I don't know about that, right? But I need to have those other pieces of information before I can even look at the bottom and see if it's reasonable. And the truth is, we're going to go crawl through their financial model anyway later. So this is a little bit more of a high level sanity test. Are you shooting for the right things? Are you kind of in the general ballpark of like reality? And then we'll go do the deeper dive later.
Should the startup put in target valuation on this slide or no?
Oh, you're hitting all the tough ones. My answer is no. Like when a startup says, we want to raise X on such and such pre-money, I'm like, do you have a lead investor? I'm like, no. And I'm like, oh, that's cute. Right? It's cute. It's nice of you to put that number in there. I'm going to totally disregard it
Right.
because the truth is, like, this is not like a Middle Eastern shook where we're going to negotiate over valuation. Like, I'm going to decide if I like what you want. You're raising 3 million. I'm going to tell you I'll give you a $15 million pre-money. Take it or leave it. The only way you can negotiate back with me is like, well, Andrew, I really want to work with you. I have these two other term sheets and they're all at 18. Okay, now you have leverage. But to tell me the numbers, it's like it's like, what do you want for Christmas, dude? Right? Like, yeah, you're not getting a pony. So I say don't put it in there. And they're like, oh, we're going to raise it on a safe. And I say, hey, Nathan, if your investor comes, I don't do safes, but I'll give you a price note. Would you take it? Like, yeah. I'm like, then why are you saying you want a safe? Now, let me put a little asterisk on that. You won't put it in there, right? Or if you're somebody I'm advising, you won't put that in there. But about 30% of the time, the investor will be, so Nathan, what do you think the valuation will be? Now, the reason we will ask that sometimes is we want to make sure that we're at least roughly on the same page. Now, sometimes you get into like really hot fields. Oh, we have an AI startup, right? And we're raising 5 million. And if they're thinking they're going to do that on a 50 million, pre-money, like that's not me. I'm not that guy. So I may ask them that just to make sure like we're kind of like as a sanity check. Now, the way I tell my guys to answer that is you've done enough research to know roughly what a fair valuation for your company is. So let's say you're raising and like you think it's like between 15 and 18, right? If that's it, you can say, Andrew, thanks for asking. Listen, we understand that the market's going to set the valuation, right? So our goal is to just run the best process we can, get as many interesting parties, good VCs to back us. But what we're hearing from the market is that we should expect something in the neighborhood of 18 million. So you can go for like the top end of the range, but at least tell me that we're in the same ballpark. And what you've just telegraphed to me when you've said that is, I understand how the game is played. I understand where I have leverage and where I don't. We're aligned at least, roughly.
Yeah, no, I like that approach. This is a tricky topic that founders often ask me about too. It's like, how do I talk about valuation? And people watch Shark Tank, which, those guys always come out there with a very specific, we're selling 10% of our equity for 400,000,
Yeah. Can I rant for a second about Shark Tank?
Huh?
Can I rant?
Sure, go for it.
You and I both know the real world is nothing like Shark Tank.
Yeah.
Right? Early stage investors, we would never do that. We listen, we might secretly be dicks, but we're not going to openly be a dick to you because we want you to like us. We want you to tell your friends who maybe have better startups than yours, they should come to us. Like, that's also why we never actually say no. Like, we all give you like the soft no, come back when you have more traction. Because we don't want you to think we're a bad guy. So we'll never do stuff like, twist your arm, at least not nearly as unsubtly as that.
Mm-hmm.
So do you remember the show Silicon Valley?
Oh yeah, absolutely love it.
So I didn't want to watch that because I was afraid it was another Shark Tank and it was going to drive me nuts until my friend sat me down and says, no, Andrew, looks me in the eye. I was like, you will like this show. Trust me, I know you well enough. And then I watched it, and everything that happened to that startup through the first 5 seasons, at least, has happened in real life to startups of mine. Not to the same startup, but that is a far more realistic and far more entertaining view of the startup world than Shark Tank.
Totally. I reference it. I do a webinar called Funding Hacks. You can find it on YouTube channel. And I reference that show, even though it's several years old now. I reference it constantly. It's perfect. Let's move on to another topic just to keep things flowing here. Prospecting for warm investors. Maybe let's talk about that, and then we'll get into kind of warm intros versus spray and pray, stuff like that. But let's
absolutely. Hit all the hot topics at once, right?
Mm-hmm.
So that's actually, if I have to kind of segment all the startups into where they're strongest and weakest, the finding investors who might be interested part is the predominant, most common weakness. You got some startups that are really good at customer discovery, really good at building a product, an MVP, and then you're like, where do I find investors? I don't know. Who could I talk to? Right. So let's start with what should be the obvious. A warm intro is the best, hands down. Right. A warm intro is like, let's say, Nathan, you wanted to get to me and you didn't know me, but you happen to know 5 people who knew me. The best thing you could do is you call your buddies and say, hey, I know you know Andrew. I think I'm a really good fit for his startup because he invests in these things, or he has invested in A, B, and C. And, my startup does X. So I think we're a good fit. Do you know Andrew well enough to make an introduction? By the way, that last part's important because some people are connected on LinkedIn, but they don't really know him. And you want, or maybe they don't want to make an intro for you, but don't want to tell you that. You want to give them an easy out so you can go ask somebody else rather than just spin your wheels waiting. But if you've done that, and then your friend who actually knows me comes up and says, listen, Nathan's a sharp guy. You should take a look at his startup. That prioritizes your startup over everything else that comes in, from other sources. And if you have a choice between asking another startup, preferably one that's already exited and made me money versus anyone else, that's the gold standard, right? Because good startup founders know good founders. So that's the best intro. Other investors, ironically, could make the worst introduction. So here, let's try this one on for size. Mm-hmm. Hey, Nathan, I've met this great startup. You should talk to him. Andrew, are you investing in them? No, man, but you should. Like, thanks for nothing, right? Now, it works okay if the answer is, no, man, they're raising a seed. I don't do seed. I do Series A, but I'm really excited about them. And if they succeed, I'm looking forward to their A round. That works. But if I could invest and I'm not, bad. Now, if the answer is yes, I'm invested, that's back to great intro territory.
Yeah. Yeah, no, that's good. Let's riff on that a little bit. So, I mean, part of the hard thing is identifying good target investors. We're trying to solve that problem in Foundersuite, but it's still a hard problem.
Mhm.
You still have to spend a large chunk of your time. Um, and it's hard to really identify like perfect fits sometimes. Like someone like
Mhm.
Andrew might look like in the right general category
Yeah.
of what I'm investing in, but I can't really tell. I can't really tell if he leads rounds, uh, doesn't lead rounds. Like, any tips for sort of narrowing the range of
Yeah.
darkness?
So first of all, like just buckle down. It's going to be 2 hours of mind-numbingly boring work. So just book that time with yourself, and then afterwards go out for a drink, a run, watch a movie, whatever it is you need to do. But just accept the fact that there's not going to be a shortcut. Those few hours of your life need to be invested in this, pun intended. So the first thing you want to do is you want to start with a good search, a good database. And your first cut can be, I'm going to look at people in the same industry. But that's not the only way. You could also look at the same kind of business model or the same kind of customer set. The goal is this is the acid test. You want to be able to come up with 3 startups that you can reference that they're in that make sense. It's like, hey, I see you invested, or I see this investor invested in Uber and Lyft. So I think they might be interested in my company, Lime, which is a bike, a scooter rideshare. Like that sentence makes sense. Now, if instead you'd said, oh, I see they invested in Etsy and Craigslist because they're ancient. Now they might want to go into my scooter rideshare. Well, that doesn't make sense because like A and B have nothing to do with C. So you start off with your list, and you can start by, okay, I want to look for all the investors that invest in construction tech. Okay, right? You're a construction tech. That's a good start. But then you need to drill down to that investor. If you've like downloaded your list of 300 investors that seem to be in the right space, then actually you can do one more filter first. Make sure if you're raising a seed round, they invest in seed rounds, right? So anyone that's like, oh, I only invest in A rounds, B rounds, or later, you just drop them. It's no use talking to them yet. But then when you have your list of people who are in the same industry in the right stage, just click through, look at them, right? First thing you look for, is there a demographic thing? Oh, we're looking for underprivileged founders, looking female founders. If that's not you, don't bother, right? Then look at their portfolio and look to see 3 examples of companies that if they invested in that, it makes sense for them to invest in you. Similar enough, but not competitive. If you had that, you've qualified that lead, that investment lead. Then you can actually use that in your email to the mutual contact and say, hey, Nathan, I see that Andrew invested in A, B, and C. So then when they've asked you for the intro, you can look at it as a potential introducer and say, oh yeah, that makes sense, right? I can put my street cred on the line to recommend them because I see exactly why it's a good fit.
Yeah. I'm gonna throw a little curveball. So this is a direct support chat from a customer of ours yesterday afternoon. The support chat says, "Hey, I have a list of several thousand investors, and I want to do an initial mailing to gauge whether there's interest in my startup to all several thousand of this list, and then for the ones that I reply, I'll do a deeper dive with those folks." And if I can tell you what my answer is, but I want to hear what your answer to that founder would be. And before you answer, it logically kind of makes sense. You have this list of investors. You want to put your net out there, your fishing net out there wide, and see if you get any responses. And then, if 300 from 3,000 respond back, maybe you go in deeper. But what would your response to that be?
Um, Dear Jim, your account has been canceled. Please go and start selling magazines instead.
Right.
So, okay, let me unpack that a little bit. Um, don't do that. I'll tell you, there's a lot of reasons not to do it. The first reason, from the perspective of the founder, is it will get him nowhere. Right? I have seen in my career well over 10,000 unsolicited funding, request emails. I have actually engaged with one of them, and I didn't fund them. And like the fact that I engaged with one of them is one more than most of my peers. And I'll tell you, the only reason I engaged was I recognized the name. He's a guy that went to my synagogue.
Oh,
And I
funny.
mostly engaged to say, oh my God, Phil, why the hell are you doing this? You know better. Right? I did it to tease him.
Yeah, right.
He actually happened to be in my space. So you don't do that because what you're really saying to the investor is, my time as a want-to-be entrepreneur is more valuable than yours. I can't be bothered to figure out if this makes sense. So you, investor X, drop what you're doing, engage mentally to figure out what I'm doing, because I'm probably like horribly incoherent at telling you what that is anyway, and then figure out if it makes sense, and then tell me. Is disrespectful to the time. And I'll give you another analogy, and this is usually like, I give this as a talk, and all of a sudden I see like half the room's face go white because like, oh my God, I just did that. So let's pretend for a moment you have a B2B startup and it's SaaS and you're selling like 5-figure or 6-figure software contracts. So before you reach out to somebody, number one, you're probably going to want to network to the decision maker right away, like through somebody who knows you. The warm intro is a better way to do it. And you know that as a good salesperson. So right away, that approach is wrong. Now, if you do need to do cold emails, you have no connection or whatever, that's the way you need to do it for whatever reason, you would, and you wrote a post about this within the past week or two, which was really, really good, but I'm going to riff on it a little bit. You would first say, okay, the decision maker at this large company that has the budget for my product and makes the decision is so-and-so. I'm going to find out everything I know about so-and-so, everything about his or her position at the company, what I think their pain points are, what's happened at the company recently. And I'm going to lay into that email. It's going to be a short email because God knows I'm not going to like throw 20 pages at them right away. But I'm going to telegraph in the first sentence or two that I've done my homework. I know what their pain points are, and this is specifically tailored to them. It's like, hey, Bob, I know with the new regulations that just passed, you have twice as much work to do, know your customer work before you can actually engage. I've come up with software that actually cuts that out and automates it. So that at least tells the person like, oh, yeah, this is actually relevant right up front. Now, how come you'll do all that work when you're looking for a 5-figure check from a customer, but when you're looking for a 6 or 7-figure check from a VC, you're going to spray and pray with a totally untargeted email? Where's the logic?
Good point. Right.
And I'll give you one other reason, just in case your audience isn't convinced. I'm one of the most networked people out there. VCs are, any social media that pops up, we try it because we never know if that's important or not. Clubhouse, anybody? I didn't because I'm on Android and they never bothered to make me feel welcome. But we're everywhere. And if you can't get a warm intro to us, or if you can't manufacture we're meeting us at a conference or like commenting and engaging with us on a Twitter feed or an Instagram post or whatever it might be, if you can't get some kind of warm introduction that way, or at least manufacture a good connection that way, I wonder if you can do sales. So it's actually a negative indicator, a yellow flag that, A, you don't get how the game is played, you don't understand, you're not respectful of my time, but also like, can you really do sales?
Yeah. No, it's good. It's, I gave similar answers. It's not going to get you anywhere. It's going to hurt you.
One of the good guys on that, because like some of the platforms, which I won't name, it's like, hey, here's how you spray and pray. And AI is just making that easier.
Yeah.
So the problem's just getting worse.
All right. We're running a little bit on time here. I want to touch on a couple other things, picking out some of your chapters. These are just intriguing to me. I don't know what you write about in your book, but Portco, Jiu-Jitsu, and dry funds. Maybe riff on those in the next 10 minutes and we'll wrap it up.
This is, let's start with dry funds first, right?
Yeah.
So I'll do a little bit of, I'm just going to start assuming that somebody in your audience doesn't know these terms. So I apologize for those of you that do. With a VC fund, usually we're raising in 3-year cycles, right? So if I have a 10-year fund, my initial investment period, when I can make my first investments in a startup, is the first 3 years. The next 3 or 4 years, I can do a follow-on investment, but only in stuff I've already invested in. And for the last 3, 4+ years, I'm waiting for my companies to exit so I can return money to my investors. So if you're meeting a VC fund and it's their 3rd year and they haven't raised a new fund, their next fund yet, they may be running low on what we call dry powder, like the part of their fund that's allocated to initial investments. Now, some funds, when they're like trying to raise their new round, but they don't have the money yet, they'll still meet with startups because they don't ever want to look like they're not active, and they may do their close soon enough that they can write a check soon. So it sort of makes sense, but they don't have any money. And you as a founder can't really know that. You can kind of intuit a little bit. Like if you click through on that founder detail that, they can get on your site, you can see when they've raised their last fund. And if it's like over 2.5 years, it's totally reasonable for you after you've done your pitch. And like, do you have any questions for me? To say something like, I see you raised your last fund 2.5 years. Yeah. How many investments do you have left? Or, how much dry powder do you have left? Are you still making initial investments? And they might say, yeah, we've got like 5 investments left out of the 30 we were targeting. Okay, it's going to be a little harder to close those guys because they're really thinking carefully about them, but at least they have it. Or they might say, actually, no, that fund is closed, but we think we're about 3, 4 months away from closing the first close on our next fund. And then if they get really awkward and hem and haw, like, not a good sign. The Portco Jiu-Jitsu, right? One of the interesting ways into a VC fund is to leverage their portfolio, right? So if you have potentially you could work together with one of their portfolio companies. When you had that first meeting, in addition to asking for money, you could say something like, hey, I see you've invested in company X. We could really work well with company X because we could help them do this, they could help us do that, they can make money. And like a VC fund's awesome. I was like, great, I'll introduce you to them. And we'll do it in part because we want to be helpful, both to our own portfolio and to other founders, because hopefully that'll, when they're ready, they'll take our money instead. That's our way of proving ourselves. I mean, unless I think you're a total clown, in which case I don't want you touching my portfolio. But if you're like at least credible, I'm like, yeah, let me introduce you to them to be helpful. And also because it gives us somebody else, because remember, lazy, somebody else who can put a sharp mind against us and tell us if it's like, yeah, that's a really good founder. So it's another data point for us. Now, something which I came across, and I wish I could remember who told me this because it's actually brilliant, and it didn't make it into the book, was let's say you're stuck. Let's say you have no warm intro to an investor. You thought you did. You asked those 3 people and like, nah, man, I just met them at a conference 5 years ago. Right. So you're kind of stuck and you're about to do a cold email to them. Consider doing a cold email to their portfolio company instead. So number one, let's say, pretend you're the portfolio guy. I say, hey, Nathan, I see first round capital invested in your startup. I'm thinking about approaching first round capital. I'd love to meet with you and just understand what your experience is like. Have they been good investors? They've been helpful? What kind of companies are they investing in now? Now, unlike VCs who are getting thousands of these, a year, and we ignore them all, another portfolio company, like they went through this not that long ago. They remember the pain. They're willing to usually give you a little bit of time. So you'll meet with them for like a half hour virtually or over coffee. Don't use the phrase pick my brain. I hate that. It's annoying, but you'll meet with them. And if they're actually impressed with you and they love what you're doing, that's really cool. You're like, hey, can you introduce me to the guys there? So you've turned a cold intro into a warm intro at that point, because that is an easier point of entry. So I don't have that in the book. It's something that kind of came after I went to press. But if you're stuck and you can't get a warm intro, that's an interesting in-between point between just cold emailing the VC.
Yeah, for sure. Yeah, I talk about that in our Funding Hacks. It's a great strategy. I like it a lot. All right, in 4 minutes or less, what do the book concludes with sealing the deal and money in the bank. So I guess let's wrap up this talk by any tips on wrapping up your fundraise, sealing the deal.
Yeah, once you have the money in the bank, get the fuck back to work. Right? That's actually the last line in the book, though I bleeped it out a little bit because it's also potentially a textbook, and I was told I had to take all the curse words out. That was 2 hours of editing because some of the curses were very creative and didn't show up in a find.
Oh, that's too bad. You need to have the unabridged version, right?
Yeah. So number one, I'm gonna tell you this: like the deal's not done until the money's in the bank. So if you want to make things, again, I'm going to just lay it out, and I have like 3 minutes left. The moment you get a term sheet, things go into fast forward. Those first 2 weeks are your chance to get anyone else that was on the fence to give you a term sheet, so you can play people against each other. So you got to be ready to do that in a smooth, not offensive way. That's a chapter or two of the book. You got to agree you got to get your lawyer to like, dude, I got a term sheet. I need you to look at this right now. Right. So your lawyer has to be ready to go into high gear. Then when you've signed the term sheet, you got to go fill out the round, unless the lead investor's like, take all the money, I'll do it myself. So you need to reactivate the people you've spoken to who are like, I'd only follow, or sometimes people who might have been willing to lead it, but are okay not taking a back seat. So you need to close that, and you have to be very, very methodical about that. And then it's not in this order, but knowing that this is going to happen and you've got like 30 to 60 days for like due diligence, you got to have your data room ready, right? So you should have your data room ready. You could be sending out your emails for the warm introductions. And while you've got that couple of weeks when they're starting to trickle in and you're doing your first meeting, get your data room ready to go so that as soon as someone says, yeah, I'm really interested, can I have your data room? Like, here's my link. Never be the holdup, except when you want to be the holdup because you want extra time to play term sheets against each other. But never be the holdup when you want things to move fast.
Give me tips on playing the term sheets. Like you get that first term sheet before you sign it. You go around to other potential lead
so the
investors.
First thing I do is like, I get a term sheet. It's like, I have a week. So the first thing you do is you call them back and say, listen, I'm really excited. My lawyer is on vacation in the Maldives. I need 2 weeks. Right. So first thing you do is get like an extra week. Then immediately you're reaching out to everyone. You want to be very respectful about this, right? You want to be respectful about it, but you want to play the game, right? Listen, Nathan, I just want to let you know we've been talking for a long time. I love your fund. I think you can do a lot more than just help me raise money. Uh, I just got a term sheet. I have a ticking clock. It's 2 weeks, right? They're nice, but I prefer to go with you. Um, hate to rush you, but are you interested? And do you need anything more from me to help you get over the hump in the next week or two to see if you want to do it or not? It's a polite, full way to say, this is it, fish or cut bait. The other thing is when you will be asked, and you will be asked, who's the term sheet from? You politely decline to say. You say, I'd love to tell you, but I'm under NDA. The reason you do not do that is because it's a small world. We know each other. And it's the most natural thing in the world for us to pick up the phone and say, hey, Bob, I see you're leading the round. They're a really cool company. What are you offering them? And we might collude rather than bidding against each other, right? He might not say anything, but he might say, I'd love to have you in the round. I'm taking 2 of the 5 or 3 of the 5. Would you take the rest? And let's offer them, 15 pre. But when you really want, because then you just shot yourself in the foot. What you really want is the other guy to come back and says, yeah, we're in for 16 or 17 pre. Or same money, but just better governance terms. So A, play for time. B, be polite, but make it clear that you want the other guys to like make a decision. And C, you don't tell them who the lead is until you've signed the term sheet, and then officially you're rounding out the round.
Yeah. I think that's a good point to conclude here. If people want to learn more about the book, where can they find it? I'm assuming Amazon,
Sure.
but
Like
where else?
on Amazon, where the entire world is. So it's the Entrepreneur's Odyssey. It's a novel guide to startup success. I like puns. I don't think there's anyone else out there, but if there is, it's the one written by Andrew Ackerman. So you can write it there. Or if you're really curious, you can go to andrewbackerman.com, andrewbackerman.com. That's my website, and you can learn a little more about it.
Very cool. I've got to go take my daughter to her dog walking job. Otherwise, I would ask you about 50 more questions, but maybe we'll pick up a part 2 or something down the line. So
You got it.
a lot of really interesting stuff here.
Thanks for having me.
Cool. Thank you, Andrew.